Welcome to our Investment Update webinar. In this webinar, Tim Farrelly, our Asset Allocation Consultant, will discuss what's happening in investment markets and how that could impact on your portfolio. I'll hand you over to Tim.
As we all know, we are currently going through a period of market volatility and share prices have fallen. Today we'll show how those lower prices mean returns will be higher going ahead. Also, we'll discuss some of the issues that are likely to dominate the nightly news in the year ahead, and in particular put some context around those issues. What's really happening? What should we be concerned about? And what should we ignore? Let's start with likely future returns. This chart shows our tipping point table. It outlines what returns you should expect to get from different markets if you invest at different prices. As you'd expect, the lower price you pay for an asset, the better returns you should expect to get. The more you pay for an asset, the worse returns you should expect to get. So what's happened over the last 6 months? Prices have fallen from the levels shown in the empty arrows to the levels shown in the brown arrows. This means that unless the long-term outlook for dividends and company profits has suddenly changed, lower prices means higher returns in the future. Look at Australian equities. A fall from around 5,800 on the All Ordinaries Index to around 5,000 today means we should expect returns close to 11% for the next 10 years instead of the 9% expectation from 6 months ago. Now, where does that expectation come from? Most of the returns should come from dividends, and dividends on Australian shares are currently worth 6.3% per annum on average if we include the value of dividend imputation credits. Even without any growth, that's much better than the 3 or so percent return we get from term deposits. And we do expect to get growth. In fact, growth of around 4.7% per annum, which gets us to the 11% per annum total return. Now, that growth is by no means guaranteed. But even if growth is just 2% per annum, it gets us to a 9% per annum total return. And growth of 2 to 5% is not much to ask, particularly starting from today, where company profits are depressed and should rebound over time. Again, we stress that none of this is guaranteed, but it is likely. Similarly, we see good value in most international share markets, as illustrated in this chart. In fact, the only market where we have some medium-term concerns is the US market. This market has risen strongly over the past few years, but the US economy is now facing some headwinds, notably from the very strong US dollar, which should eventually slow the US economy in the same way as the Australian economy has been hurt by the high Australian dollar over the past 5 years. Elsewhere, we expect most other share markets to give returns well in excess of the returns we can get on term deposits. And this is despite all the bad news we've been hearing lately. So what is the 6 o'clock news suggesting about where returns are headed? As far as the media is concerned, it's all bad news. Here are the stories we're starting to hear, and you can expect these stories to become louder and louder over the next 6 months or more. We're going to hear a lot about a possible recession in Australia. Recession stories will often be linked to stories about a bursting residential property price bubble. Those two stories will get the media talking about pressure on the profits of Australian banks. And of course, fears of an imploding Chinese economy will continue to get lots of airtime. And if that's not enough, returns on safe alternatives such as term deposits will fall again. So what's really going on? Which things should we really worry about, and what's just hype? Firstly, the possibility of Australia entering a recession is real, and we're going to hear a lot more about it in coming months. Two major drivers of a slowing Australian economy are firstly, the end of the mining boom, which means that spending on big resources projects is falling away quite quickly. Secondly, we have the possibility of slowing residential construction, which up until now has been one bright spot in the Australian economy. We don't believe that either of these will be enough to tip the economy into recession. However, they may take us close. If on top of those factors we get falling consumer spending as a result of falling confidence, that may be enough to get us into recession. This is a genuine concern because recessions typically come with falling share prices. However, it's critically important to remember that firstly, it's by no means a foregone conclusion that we will have a recession, and secondly, not all recessions are the same. The recessions we should worry about are deep, long-lasting and cause substantial damage. Other recessions are relatively shallow, and generally see companies and economies quickly recover and as a result are much less of a concern. The type of recession we fear are those caused by overheated lending activity, a collapse in both property prices and property construction, typically resulting in heavy losses for the banking sector. When this happens, it often leads to a collapse in lending and confidence, leading to further falls in activity. It's the deep recessions that we worry about. However, when we study the evidence, in particular the current state of the property market and the lending activity of the banks, we can see that any recession is likely to be mild. And that's even throwing in the other widely discussed wildcard, a collapse in the Chinese economy. So let's begin by looking at the residential property market. As we all know, residential property prices have soared in recent years, particularly in Melbourne and Sydney, as we can see here. Is this a bubble about to burst, as many have suggested? We don't think so, even though we do think that residential property prices are probably 10 to 20% too high, particularly in Melbourne and Sydney. So a fall in prices of 5 to 10% is a distinct possibility, as incidentally is the possibility they'll continue to rise. What we don't expect is a crash. Property crashes are typically caused when you have excess building leading to an oversupply of property coupled with sharply rising interest rates and sharply rising unemployment, which can create forced sellers. Normally, to get steep falls, we need at least two of these factors at play, if not all three. So let's have a look at building construction. Have we been overbuilding? To answer that, let's first see what a real boom and bust looks like. In this chart, we see new home construction in the United States since 1992. The number of houses being built in the US rose 50% between 1999 and 2003, and then rose significantly again through to 2006. That's 7 years of massive overbuilding, resulting in way too much property on the market. When the global financial crisis hit, construction activity collapsed by 2/3 over 3 years, and that contributed significantly to the US recession. So how does Australia compare? The blue line shows the number of houses built in Australia each year since 1992. The contrast with the US is very clear. Building activity here was steady until 2013, and since then we've had a good increase in residential construction, but hardly a boom. This pickup is a concern, but a minor one. Most of the building has been to address a shortage in housing resulting from years of underbuilding, and secondly, the scale of the increase is dramatically lower than we saw in the United States. If building continues at this rate, we will have more concerns. However, we think that residential construction in Australia will slow well before we get a glut of property. That will slow the economy, but not catastrophically as was the case in the United States. So, we think there's no property glut. What about factor number 2, rising interest rates? Regardless of whether the economy is merely weak or actually in a mild recession, what we do know is that the Reserve Bank will not lift interest rates in either case. In fact, we expect the Reserve Bank's next move will be to reduce rates further. And this is exactly what the markets are predicting. As can be seen here, the financial market's expectation is that Australian interest rates will continue to fall until 2018, and then will go up very slowly after that. So, no property glut, no rising interest rates. As a result, we think that any property price downturn will be mild and definitely not the crash that many in the media are predicting. What about other key investments, in particular bank shares? They are often major casualties of recessions, and they form a large part of many portfolios. So it's an important question to address. In short, we think the banks will do much better than they have done in past downturns. A recent research paper from the Reserve Bank found 4 key triggers of high bank losses due to bad debts. They were 1. Rapid growth in lending, which 2. is generally made worse by loose lending practices. Thirdly, high levels of construction activity, and finally, rising interest rates, which puts borrowers under pressure, often leading to default. So what do we see today? Well, it's quite the opposite. Lending growth has been slow. Secondly, lending standards have been tight and getting tighter. Thirdly, as we've seen before, residential construction has increased, but not dramatically so. And as we've also noted, interest rates will not be increasing anytime soon. On top of all of this, the banks have been actively raising capital in recent months, which puts them in a stronger position to weather any storm. The banks may not enjoy a recession, but any wounds are likely to be temporary. So, what else could go wrong? A hard landing in China is the next item that is dominating the airwaves. The fall of the Chinese share market has been very much in the news recently. This really needs to be put in perspective. This chart compares the performance of the Chinese share market in blue with the US share market in red over the past 12 months. They're like chalk and cheese. Prior to falling almost 40% recently, the Shanghai market had risen by 120% since this time last year. And even after the 40% fall, the Chinese market is still up by over 40% over the year. In so doing, it has easily outperformed the US market and in fact is the best performing market in the world over the past 12 months. So what do we take from this? Is the Chinese economy 40% stronger than a year ago or 40% weaker than 3 months ago? The answer, of course, is neither. The performance of the Chinese share market has almost no relationship with the performance of the Chinese economy. And because the Chinese are our biggest trading partner, it's the Chinese economy that Australian investors should worry about. In this chart, the dark bars show that the rate of Chinese economic growth is slowing, but it is still growing and at around 6.5% a year. That's much higher than the growth rate of the United States, which is growing at a little under 3% per annum. From the perspective of the Australian economy, we just want to see continued economic growth in China, which should underpin demand for our main exports, iron ore and coal. For us to be really concerned, we would need to see demand for iron ore and coal actually fall as opposed to simply grow more slowly. We do not think this is likely in the next year or so. So, in summary, the Australian economy is slowing and a recession can't be ruled out. However, and most importantly, any recession is likely to be mild and should not have much of a long-term impact on company profits. Thirdly, residential property prices are likely to fall somewhat, but we don't think they'll collapse. The banks are sound, well capitalised and should easily weather any downturn. China is slowing but still growing strongly, and the gyrations of the Chinese share market are a sideshow that should just be ignored. Interest rates will fall further, which, while it is bad news for TD investors, will limit the depth of any recession. For investors, all of this means that share prices here and overseas are great value. Prices have fallen, reflecting the short-term gloom. But if we pay less for the same dividends and for the same long-term growth prospect, it means higher returns going ahead. So over the next 6 months, we recommend that you just ignore the news. It's a great time to be fully invested.
Thank you for watching our Investment Update webinar. If you would like to discuss your investment portfolio, please contact your financial advisor. For more information on investing generally, please visit our website. Thank you.
This webinar is of a general nature only, and the performance figures presented are not indicative of future performance. Given that most people have fairly complex financial situations, you therefore shouldn't take this information as personal advice. Everyone has different financial situations and requires solutions and plans which are tailored to their individual situation, and we will be pleased to provide you with that personal advice if you wish.